Well, I agree that it would be much more volatility, for sure, and it'd make investors a lot less comfortable. But I think there's some positives to it also. For all of us who are long-only people who are doing stock picking, doing research, it'll mean that we'll be more valuable. Active management will become more and more important because we'll be doing our homework between those quarterly calls.
Right. Does it ice out the individual investor? Does it ice out mom and pop because they can't pay for that additional edge, those incremental data points in between?
Well, it will be harder for mom and pop investors because you're right, they'll have to wait longer for the data. They won't have the access to management that we do as professional investors.
We also ask all these questions in the context of a company that's doing well or wants to make good choices about, the future. But when you have to wait 6 months, if things are going very badly, if it takes that long to figure out how bad things are, isn't that completely detrimental? I mean, you want to know when things are going poorly, right? I just got to think companies in trouble will use this to suck money out of the capital markets in a way they wouldn't be able to otherwise.
Well, I think you're right. Managements that are not doing well, people get big shocks, and you'll have stocks down 20, 30, 40% in a day, because now we're seeing stocks going down 20%, on disappointments. It'll probably be much, much greater if you've had 6 months of bad news. But again, I think us active managers will hopefully take advantage of those market inefficiencies and be able to do our homework and be able to figure out maybe make some active choices that will be positive for our customers.
So is it too simplistic to say this kind of proposal that President Trump is laying out would benefit CEOs, management teams, and boards, but not necessarily investors?
Well, I think that it would definitely help management. They spend so much time preparing for these meetings, rehearsing, getting ready for the conference calls, getting ready for their television appearances, and they're not spending their time, running their business. So I think managements will be able to spend more time on what they're trying to do, make sure their products are great, that their customers are having a great experience, and spend less time preparing to please Wall Street. So it'll be good for management. But again, it'll cause more volatility for individual investors.
When the rubber hits the road here, though, Ben White out of Politico today suggested that the most that's going to come out of this is an SEC white paper saying, yeah, maybe it's not so great, these quarterly numbers, and that's where it's going to end. You think this has traction? Could this actually happen?
Well, you never know these days, that's for sure. Everything's a surprise. But I think it's not impossible. Anything that makes the capital markets or makes management teams be able to spend their time more effectively and efficiently, they might be pushing for it also. So the SEC commissioner will hear from the president and a lot of business leaders.
Well, also, we're going into the midterms, and, it's not that different from... Jim Cramer had a conversation with Senator Elizabeth Warren this week, and the whole sort of broader question of, are companies fulfilling their responsibilities to their employees, to the broader society, to the economy, or are they just incentivized by stockholders, by their own equity, which is tied up in the market? This is sort of a bigger debate that seems like it's happening as we look for ways to increase wages and productivity, which just haven't really been key pieces of the economy. And I think we're going to continue to have these kind of conversations, don't you?
I do, but I think some of the most extraordinary investors of all time, Warren Buffett has his annual meeting, his big annual letter. He doesn't do quarterly guidance. He's not coming on and talking about the quarter in any detail. Same time, great investors like Joe Mansueto at Morningstar, the same way. They're spending their time focused on their businesses and realize they shouldn't spend all their lives, planning for those quarterly reports.
Yes, but if you're Snap and you go public and investors have real questions about how reliable your finances are going to be or your profitability is going to be, can you imagine if they took away the quarterly reports out of the gate?
Well,
that's where I think you'd see the multiple contract, right? Even more dramatically than what you have. Big uncertainties, so you take out some of the premium in the
stuff. In the short term, but eventually the markets would adjust. People would get used to it because cash flow won't be affected, the quality of the business won't be affected, and ultimately the stock prices are going to reflect the discounted value of those future cash flows.
Yeah, I guess it's just that you won't know for 6 months what the cash flow is, right? That's the issue. And if it goes negative, if it's not as good. I mean, what if we had waited 6 months on GE, right? I mean...
Well, you remember, our logo is a turtle at Ariel, so we believe in that long-term perspective, and patience wins.
Right. Speaking of which, what's your overall sense of valuation here? I mean, what a crazy week, as we mentioned, with emerging market concerns and the dollar and everything else. Do you think, are these concerns overdone?
I think the concerns are overdone. I think they're very short-term in nature. I think multiples are very, very reasonable here. I think that we can really make a case that with the earnings coming through so strongly, the stocks are still bargain priced. And if we think long term, I think this is still an opportunity in a lot of industries to get in there and make great purchases.
Michelle and Sarah were just making the point of defensive names making a run here in the last few weeks. There's a story today out of Bloomberg about tech and momentum sort of dovetailing again and creating a would-be risk to the market if tech were to stumble. Are you talking X-tech or are you talking the market at large?
I think X-tech, I think it's going to be a little bit like the end of the century. When the technology stocks start to roll over, those traditional value stocks will start to shine, and those managers that are focused in that sector will really, really, really
Finally,
good.
this time it's going to happen? I mean, what's different now versus this is all the false starts for the value stocks over the past few years?
I just think simply it's the earnings of these cheaper, undervalued stocks that have kind of been orphaned by the market. No one cares about them any longer. I think if they continue to show great cash flow, great earnings, the markets will rotate back, and people realize that technology stocks have gotten very, very expensive, and there's lots of new competition coming in trying to disrupt the disruptors.
We've been asking now for almost 2 weeks, are people worried about Turkey? Let me ask you a different way. There are people who look at Turkey, Argentina, maybe even China, and say, this is just the beginning. This is the first whiff of the great unwinding of the central banks around the world. And that as that progresses, Turkey is just the tip of the iceberg. Argentina, just the tip of the iceberg. How worried are you about what appears to be the great unwind of the huge experiment of the last 10 years? And what does that mean for our markets?
I think it'll just be short-term in nature. As you know, a few years ago, we were all fixated on Greece. That was all we thought about. And eventually, just these things, the markets come around. If you think long-term, you get through these things. You look out 3 to 5 years is what we always try to do. We'll be talking a whole other challenge. We won't be talking about Turkey 3 years from now.